Good evening, everybody, and welcome to our continuing education series. Uh, this month, we are going to be focusing on women and money, taking charge of your financial future. So I want to start by sharing my screen here. And again, women face very unique challenges when it comes to their financial future. And we always are constantly trying to help them chart that course. So it's more critical than ever to women to know how to save, invest, and plan for their future. Now, there's good reasons for optimism. Women today have never been in a better position to achieve financial security. When it comes to the clout of women in the workforce and their economic power, uh, first of all, they make up about half of the workforce. This is all based on a recent census survey in 2020, and women account for more than half of all the workers in management, professional, and related occupations. Women own millions of businesses, and women earn the majority of all bachelor degrees, master's degrees, and doctoral degrees. Bottom line is that women's economic clout is significant and is something to be dealt with here. Um, some of the potential challenges, though, are quite different for women versus men. And, they really often need to have some very specific ways of viewing their financial challenges. And first of all, at the onset, women tend to live longer than men. The average expectation is probably around 5 years longer than a man. Uh, Women generally earn less income and may have less savings than men. And women are more likely to interrupt their careers to raise children or care for other family members. And then another challenge is that women may invest too conservatively. So let's talk about each of these items here. Again, as I just mentioned a few seconds ago, women on average live about 5 years longer than men. So the challenge here is we need to be able to make sure that we stretch their retirement dollars a little bit further to make sure that we can accommodate that they don't run out of money in retirement. Women are more likely to need long-term care because, again, they're living longer and they face some healthcare needs along the way. And they may have to do that alone if their spouse has predeceased them. Women are more likely to have the sole responsibility for financial decisions and disposition of marital assets and estates. So again, these are all some of the main challenges that women are facing. So let's focus on the income issue here. Generally, women are still on average earning less for the same job that a man gets paid for. 82% on average is the amount that women make compared to their male counterparts. I personally have two daughters. They're coming up through college and young professionals. And I see how this plays out in amongst them and also their friends, as well as other occupations and businesses that I deal with. Obviously, if they're making on average 82% of what an average man would earn, this impacts their long-term savings, Social Security benefits, and if their business offers a pension plan, what those potential benefits would be in retirement. This also provides an increased vulnerability to unexpected economic obstacles, job loss, divorce, if they're a single parent, if there's an illness, or again, they lose a spouse. So those things definitely have implications for a woman's life, and again, how they can approach investing in their needs. Let's talk a little bit about the caregiving side. Women are more likely to take care breaks for helping out their family. This reduces their income. So we have lost income. They also will tend to have employee benefits not available to them that they previously could. Again, lowering their Social Security benefits in retirement because, again, they're taking breaks in service in working. Economic vulnerability in the event of a divorce or a spouse's job loss. And again, possibly difficult finding a comparable job. And again, these are the challenges that women are constantly facing. And again, flexible schedules. This can impact, again, their salary levels and career advancement. So as we go through all this, we want to really, address these items individually. And again, talking about women and again, how they may invest too conservatively. This tends to lead to a situation where their retirement nest egg may not be adequate to provide the income that they need in retirement. Now, this could be due to several factors. Generally, they may be more risk averse, or again, looking at the idea that they don't want to lose anything. So, those are some of the challenges. Again, one of the biggest challenges your dollars have, though, is that inflation eats away at the value of a dollar every year. Right now, we happen to be in a very high inflation period. So a dollar from a year ago is worth approximately 5% lower than it was at that time. So again, inflation reduces purchasing power. And when we come to the idea of investing, you have to understand the risks that you're taking if you are considering an investment portfolio. If you don't take risk, you don't get the reward. A risk-free return today would be in a bank savings account or a money market, and we know they're paying very low interest rates, but there's no risk. But the problem is that type of savings is not keeping up with inflation. So there is a balance as long as you understand the amount of risk that you're taking, and we're going to talk about that. But the most important aspect to all of this is that one size does not fit all. Not all women will face these types of challenges, but it's important to have a good understanding of them and being able to move forward financially with them in mind. Let's talk about some of the things that you can do. There's basically 6 that we're going to address here. First is taking control of your money. And again, when you take control of your money, you want to actively engage and understand what the reason and use of the money will be. Become a more knowledgeable investor. Again, this is something that we're going to talk about in more detail. Advocate for yourself in the workplace. Plan for retirement. Protect your income and assets, and create an estate plan. These are all items that we're going to talk about individually right now. So first, let's talk about taking control of your money. This means that no matter what stage in life you're in, realize that you have a responsibility for your own financial well-being. This means that you should know your cash flow. And what I mean by that is, after you have all your deductions taken out of your paycheck or whatever income source you're utilizing, make sure you know what income is going to be flowing into your household at any given time. And then, assuming that you want to maintain a positive cash flow, you should really focus on budgeting. Now, that's probably one of the hardest words for a lot of people to embrace, but simply stating is you're living within your means and you're managing debt. Now, debt is not uncommon. People have mortgages, credit card debt, things along those lines, student loans. Again, understanding why you have the debt and if it's not excessive is very important. But living within your means is probably one of the biggest items here I can stress with anybody. A lot of the millionaires that I know are all living below their means, even though they could spend more money at any time. The way they achieved financial success was living below that. So keeping that in mind, managing your debt and following a simple budget with your cash flow will help you achieve all of these facts. Create an emergency fund. Now, an emergency fund typically is 3 to 6 months of an individual's regular monthly expenses in an account that is liquid and accessible at any time. Generally, we recommend a money market for this type of savings, but again, you want it to be liquid and accessible. Things happen in life. The boiler breaks, your car needs a repair, maybe you need a new car. So these things come into play when you start to create that emergency fund and what the usage would be. And then maintaining and establishing good credit. Credit is what helps us all move forward in life with either buying a home, applying for credit, student loans, things like that. So know your credit score. It's very important. And if you have had credit issues in the past, look at a service that could potentially help you clean your record up and get your credit scores going back in the right direction. And again, going back to the idea of managing your cash flow with budgeting and things along those lines, I think is very important, and living within your means. Try not to utilize credit cards extensively, as credit cards have extremely high interest rates. And, again, they will never clear themselves out if you're just making minimum payments. So keep that in mind. Try, if you do use credit cards, pay them off monthly. And then set clear financial goals. By this, I mean, maintaining a good positive budget and cash flow, keeping that emergency fund going, and maintaining that credit score. All of these are great goals to maintain for your future. Now, let's talk about being a more knowledgeable investor. There's always room to learn. And, any plan that you have has to be based on your own circumstances. Now, considering that, if someone is just starting out as an investor, you can get some basic information. Now, when I talk about basic information, you'll want to learn simple investment terms, concepts, and types of investments, such as the differences between stocks, bonds, mutual funds, what is asset allocation and diversification, cash equivalents, dollar cost averaging, and so on, risk versus return dynamics, and so on. Take small steps. Don't postpone getting started. These are all some very basic ideas that the earlier you start investing and saving money for your future, the less you actually have to contribute into a savings account down the road to achieve that retirement goal that you're looking to achieve. And when I go back to the first items here, get some basic information and take small steps and learn as you go. There's so many resources online that you can tap into that can really get into details about the differences in investments and so on. Investicopedia is a tremendous online resource that many people utilize, and it is generic. It's not promoting any particular company or investment out there. It just gives you all of the background on investment basics. And then if you do have a situation, find an advisor, that's someone that you know can help, and ask questions. Anybody out there that is helping you with your investments should always be available to answer your questions and really guide you down the path here of what's appropriate. Now, if you're a more experienced investor, one of the items that I try to bring people into to understand is make sure that your portfolio is really focused and aligned with your goals, your time horizon, and your risk tolerance. Setting goals for the portfolio is so important. And that could be just simply establishing some return that you're looking to achieve over time, whether it's 6%, 7%, and so on. And then trying to back into the various investments that will help you achieve that. Time horizon. When we start talking about retirement, knowing that, hey, I'm 30 years old or 40 years old, and I've got 30, 40 years, 20 years to retirement, whatever it is, know your time horizon. And as I was talking about earlier, don't postpone getting started. The earlier you start, the better off you're going to be down the road, because of the power of compounding interest and things along those lines. And then lastly, we were just mentioning here, risk tolerance. Risk tolerance is probably, again, one of the more overlooked areas. Someone sees a friend making an investment and may see that investment going up dramatically. We see this in some of the more speculative areas of the market. And they think that they're missing out on something and they want to jump into it, but they don't understand the risks. As I was saying earlier, no one size fits all in this particular circumstance. Everybody is different. That person, that friend of yours, may have a very high risk tolerance and likes playing around in investments and things along those lines, and doesn't mind taking a loss for the opportunity for a large gain. But you have to understand who you are. And a lot of investment sites is what and typically what we do with clients before we start an investment program is we will walk them through a risk tolerance profile just to have a better understanding of looking at their situation. And then once you understand those risks, you want to know how to manage it. And that again falls back to knowing some of those basic terminologies that we talked about with investment education. Diversification is probably the most tried and true method for managing risk. And then understanding what you own. If you own a particular mutual fund or a type of stock or a bond, understand what it's invested in, what kind of company it is, what are the terms of payments on the bonds and things along those lines, the credit quality. Again, knowing these factors will help you in designing an investment strategy around those goals and objectives that we were talking about earlier. And again, knowing what the risk factors are for each of those investments. And then keep an eye out for ideas. I like to talk to individuals and, people that are looking around as what's going on with kids and what they're maybe looking at with all of the games that are coming out, or maybe you see a certain type of green investment that someone told you about and you want to understand more about it, whether it's solar energy or something along those lines, or even battery storage companies. I have clients coming to me all the time asking me about particular investment options that they're considering, and we review them again to understand the risks that are involved with this and how it fits into their overall investment ideas and agenda. So when something does pop up that looks interesting, go online, look at the company. There's so many resources out there that you can utilize, that you can research the data about a company or a particular mutual fund and so on, and understand what is in that particular investment that's appealing or not appealing. Some of the best investments you make are the ones you don't realize, because you're avoiding that risk or that potential downside. And then also consider any taxes, fees, and again, inflation, which is, again, always in the background challenging us. This is not a set it and forget it situation. We always have to be monitoring and making adjustments to the portfolio. So just make sure that when you do make a particular investment, that you are checking it. I have a joke when we do 401k enrollment meetings with the group. There's a comment that we make that people spend more time during the year planning their vacations than they do looking at their retirement account statements that come out quarterly. And it's true. And they all laugh and everybody understands this. But as an investor, as an individual, as a woman, again, wanting to be more engaged in understanding investment planning, you have to continue to monitor what's going on in your accounts and just have a good understanding of where your investments are. And again, are you on track for your goals? And last, have a plan for volatility. One thing that we're experiencing right now over the last couple of weeks with the invasion of the Ukraine by Russia, the markets are going a little crazy. We see oil is spiking up to all-time highs, and it's creating a lot of volatility. Understand why this is happening, and these types of situations geopolitical can tend to be more short-lived than long-term. But at the backside of all of this is we have inflation looming in the background, and we have our Federal Reserve ready to start to raise interest rates. So we're seeing a lot of volatility over the last couple of months as a result of all of this. And again, have a plan, make adjustments in the portfolio. Again, go back to the original goals and time horizon and the risk profiles of the investments and manage that risk. Understand your own risk in how that plays into this entire story. And again, make any ongoing adjustments that are necessary that can preserve your assets as well as still allow for the opportunity for growth. Now, let's talk about becoming a more knowledgeable investor. And the first thing that we always talk about is be willing to admit a mistake. The best money managers out there have lost money, and they do frequently on various investments. It's just that the majority of them tend to make some money on the most of the investments that they put positions into. So, but if you are seeing a particular stock that you like and you're buying into it, When I said earlier, set a specific goal for it. So if you know you're buying this stock at $20 a share and your goal is to make at least 10% on the upside or 20%, whatever that goal is on the upside, that's great. Have a predetermined profit margin that you're looking to achieve. Conversely, though, if there is downside risk to this model, this in particular stock, set a loss factor that you can tolerate, whether it's 5% below what you bought it at, 10%, and so on. Don't just let it ride down. If you see it going past that risk tolerance level that you have at a 10% loss or 8% or 5%, whatever that number is for you, understand that you need to be disciplined and remove that stock from your portfolio and sell it out. Don't get emotional about it. Admit your mistake and move on. It's fine. No one's going to be more critical than yourself on this entire thing. And believe me, I hear stories of how people rode a stock up to its great highs and then just watched it come all the way back down again to below what they bought it at. So just be aware of that. Again, be risk averse in the right way. Understand the risk that you're taking at any given time. And again, how it works into the portfolio. But don't have the knee-jerk reaction to just sell everything if you see the market going down, because you'll never know the exact time when to get back in. It is better in most cases if you just stay fully invested throughout a particular market cycle or a particular volatile situation. And the best example is what we're, again, experiencing right now with the Russian-Ukraine situation and the potential for rising interest rates. We're seeing volatility. Right now, you just should be staying the course as this goes through, because again, if your objectives for your retirement have not changed, there's nothing in the portfolio that needs to be adjusted. Know your account numbers and passwords. Being organized with this information is so critical. And someone within your family or close friends should also get a copy of this should you be incapacitated and they need to follow up with some specific actions for you financially or something along those lines. And we'll talk about that in a little bit when we talk about the estate planning aspect of everything we do. But again, just keeping a running list of all your account numbers, login, and passwords are critical. Know when to get help. So if you do need help with anything, contact your accountant, your attorney, your financial advisor, whoever you're working with, and they should be more than happy to provide you with any information that you're needing or answer any questions that you have. Now, probably one of the biggest aspects of a woman's world in the workplace is the fact that, again, as I mentioned earlier, women are making about 82% of what their male counterparts are. So it's extremely important to advocate for yourself in the workplace. Negotiate a starting salary that makes sense for the job that's being done. Again, the employer should be blind to the fact that you're a woman or a man, it doesn't matter. Again, more starting salary, the more you're able to save and invest now for your future. And the salary that you're receiving is, again, your foundation for all your other benefits in your life. Research your salary. Understand that there are websites out there like salary.com that you can look up your job position and see what that position is actually paying in the marketplace for that particular position and the work that is being done. Again, it's a tool. It's not 100% accurate. Circumstances are different. It's a relatively generic site, but it will give you some basis for you to have a conversation with your employer about what your starting wages should be and ongoing salary and increases and benefits within that organization. And make sure that you speak up about your accomplishments. Really, there's nothing wrong with saying to your boss at any time, hey, listen, this job was done, we did a great job, and if it warrants and there's opportunities for either pay raises or promotions based on job performance, ask for them. There's an old story out there. You miss 100% of the shots you don't take. So if you're not asking for it, they may not be coming to you and saying, hey, we're going to give you a raise because you did such a great job. Just put your word in and ask for flexibility if needed. Again, at the workplace, women have a unique circumstance, and advocating for yourself is extremely important in a lot of these areas. Now, again, talk about job flexibility. When we talk about, all of the opportunities right now with the pandemic, we're all seeking opportunities for either flexible time or telecommuting. Now, people are starting to come back to the office, but I have known quite a few organizations that got so comfortable with their entire workforce working remotely that they have gotten rid of all of their formal office space and are just using temporary rental conference rooms and office suites and so on, where they can just meet with clients when necessary. So telecommuting today is probably one of the biggest trends that was a benefit coming out of the pandemic, giving people job flexibility. Maybe it means your hours instead of 9 to 5 are going to be 7 to 3. Maybe it's going to be a situation where 2 days a week you telecommute, 3 days a week you're in the office, or vice versa. So again, just understanding these concepts and options that your employer may be willing to provide to you, again, with the flexible hours and so on, even if you had to go to a part-time schedule, again, advocating for yourself and asking for these options. Many employers today are providing it. And, again, growth trend. When we start talking about the growth trend of women in the workplace, this is happening. And again, we're seeing more and more women working in the offices with families, with a spouse or without a spouse, that are really, this is happening more and more. It's not pulling backwards. We're not seeing many stay-at-home people anymore. So again, advocating for yourself in the workplace, flexibility, telecommuting, any of these options that make sense for your circumstance, we encourage everybody to take advantage of them if available. Now, as I was saying earlier, planning for retirement. If you look at this particular slide, and this is basically just showing a simple situation wherein if an individual, based on their age, started saving in this first column $2,000 per year, what will they have at age 65, averaging a 6% annualized return? And you can see here the differential here, just on the first two items here. Someone starting at age 20, going to age 65, putting in just $2,000 a year is going to have $425,000 available to them for retirement. If you look at the person that is 30 years old, that starts when they're 30, they have almost half saved at age 65. When we get to 40, again, it keeps dropping here. So again, we're going back to the idea that the more you can save at the earlier ages really does tend to help you with compounding interest, save more for your future. A friend of mine had a good saying, drips make puddles. So even a few dollars a week, maybe you have a retirement plan available at work, things along those lines. Start small, but again, keep adding to it over time. Now, as you go forward here, you'll see some other numbers at saving $5,000 per year or $10,000 per year. Again, the numbers speak for themselves. The more time you have on your side to save for your future, the more money you will be able to accumulate. Now, planning for retirement. Again, save as much as you can. Realize, if you do have the availability of a 401k, a 403b, a simple IRA, or anything like that at work, where it allows you to put money into your retirement account, the majority of them are on a pre-tax basis. So understand that contributions into a retirement account on a pre-tax basis, when you have that deduction coming off of your paycheck, so let's say you have a $100 contribution going into the account. If you are in a 25% tax bracket, realize your net take-home pay is only going to be $75 less, but you put into your savings account $100. So keep that in mind when planning your budgeting, as we talked about earlier, and again, how much you can save. You want to really use the idea of saving at least 5 to 10% of your pay. We really try to get people to go higher than that. Realize one of the biggest challenges we're going to have, and we're going to talk about this in a little bit, is Social Security. And this is a diminishing benefit for a lot of people. The government knows this. They are trying to get people to save more money for their future, and utilizing a 401k, 403b, or something like that is really one of the best options that are available to individuals, assuming your employer offers it. About half the companies in the country offer this option. If you cannot participate in a 401k or a 403b, go to an individual retirement account, an IRA. And then there's other options, Roth IRAs and so on, and we'll talk about those. Again, put yourself first, pay yourself. This again is the idea of having this money taken directly out of your paycheck before it even hits your checking account. And you're able then to just live on the difference that's available to you there. Again, joining that employer plan, 403b, 401k, and so on. And considering the IRAs, again, if those aren't available, IRAs like a traditional pre-tax IRA or a Roth IRA, which is a post-tax contribution, but allows you to withdraw money tax-free. There are some specific benefits to that. Again, read about them, understand the differences. It depends also a lot on what you anticipate your tax bracket to be in retirement. And then set those savings goals and keep track of your progress. If you know you need to have in retirement $1 million, understand your time horizon and the amount of savings that you can contribute in each pay period as you go forward, with your assumed interest rate keeping you on track. This is probably one of, again, the most important aspects of this. And again, keeping track of the progress and making adjustments, as we talked about earlier. Let's talk about that Social Security benefit. This is a major source of guaranteed income for most Americans. The problem that we're seeing, though, is the average Social Security benefit out there is approximately $1,200 to $1,300 per month. If the average person was relying just on that as their only source of income for retirement, they would be living at approximately the poverty level. So again, the government is wanting to make sure that people are contributing to other types of retirement savings accounts for their future. But one of the most important aspects of all of this is, first of all, understanding what benefits you are entitled to. There will be something, but it's important to know what it is. So if you haven't gotten the paper statements, the government has switched to an online system. You go to www.ssa.gov, Social Security Administration.gov. So ssa.gov, and you will be able to pull up on their system all of your retirement benefits that you're eligible for at various years. And again, helping you along the way with being able to estimate what other savings are going to be necessary for your comfortable retirement. Now, basically on Social Security, it's providing those basic benefits that include both not only income benefits, but also various disability and also survivor benefits. Qualified for Social Security benefits, you generally have to have 40 credits in the system. That means approximately 10 years of work. If you are married to someone, whether if your benefit is higher or if you are entitled to 50% of your spouse's benefit, whichever one is higher is typically the one that someone would elect at that time. So again, understanding what benefits you have and how much you have paid into the system over your years of work. And again, as I was just saying, the amount that you've earned over those years is part of the calculation, and obviously with the FICA taxes that you've paid into it over the years. You can get that estimate again at ssa.gov, and they also have available a retirement estimating tool to help you understand what savings you're going to need in addition to Social Security. The ages that you can start claiming benefits under Social Security is at age 62. At this age, though, you are going to receive approximately 25 to 30% less than your full retirement age benefits. So just understand that. Depending on what year you were born, your benefits will start at either 66 or 67. Now, there is a lot of people that also like the idea of deferring the start of Social Security until they are at age 70. The benefit to this is that the benefits will grow approximately 8% per year. So you will actually end up getting 32% more in your benefits if you defer it to age 70. Now, there's a lot of debate when someone should maybe take those benefits, depending on, again, whether they take it at 62, 66, or 70. And what we've seen is the break-even analysis tends to be at age 78 to 79, depending on the individual and the amounts that we're discussing. So if someone did take benefits earlier, it takes you to about age 78 to balance out the differential that you would have potentially made if you waited a few more years and took it when at your full retirement age. So just understand that. Most people, though, if they are going into retirement mode, start taking their benefit at age 62. Now, this just talks again about, at the various ages, if someone took, for a hypothetical purpose, at age 62, were eligible for a $1,400 a month benefit. If you waited another year, it goes up to $1,500 and so on. And you can see how it increases every year that someone does wait. And that age 70, again, gives you that 8% compounding interest. Planning for the retirement. Other things you need to think about when you retire. Again, what is going to keep you busy? Understanding, are you going to be doing more travel? Are you going to be home more? What hobbies might you be engaged in? What kind of social circle are you going to be engaged in? So again, when you retire, you want to have some focus on this. And again, understanding what's going to keep you busy and feeling fulfilled. But also, you don't want to spend money, again, excessively, knowing that it is a fixed amount of income you typically would be receiving from your retirement benefits, whether it's from a combination of Social Security, a pension plan, and other savings that you have. If there are any shortfalls, again, what we typically like to see is that, you may need to use some credit, but again, living within your means is probably one of the most important things, again, that we need to focus on here. You don't want to be running up debt when you're in retirement. And that's one thing that everyone has to be very careful with. As I said earlier, try to pay down your credit card bills every month. And then again, healthcare expenses. The average person going into retirement will spend, anywhere from $200,000 to $250,000 over the course of their lifetime in retirement on medical expenses. Now, this could be insurance premium costs. This could be out-of-pocket expenses, depending on what your needs are. So just understand that these expenses are going to be part of your retirement budget. So again, you want to really keep that in focus when you're planning that budget and how much income you have coming into the household. And again, longevity issues. We know that women are on average living longer than men. So we want to make sure that your benefit dollars, the money that you're receiving every month as income, is able to you won't be able to outlive those dollars. We want to make sure that they go right to when your entire life is covered and you're living a very fulfilling lifestyle that you really are aspiring to. And then understand, again, the distribution options. Which are the best ways to access this money? What are the tax consequences? How much safety do you need to have built into the portfolio for the interest rate that you're assuming? And then we talk about protecting this assets. Now, if you are the main breadwinner in your household, or you have debts, you may want to consider having some life insurance in place. Again, this really, protects the people you leave behind from paying off all the bills, a mortgage, things along those lines. If you have a situation where you become disabled, again, understanding what benefits you have available either through your employer, or if you're a person that's a professional, you may want to have individual disability insurance, home and auto insurance. Make sure you have the right limits on your coverage. If you have a lot of assets, make sure they're insured appropriately and that you get an umbrella policy on your home with at least $1 million liability limit. Again, we're in a very litigious world, and if God forbid someone is in an accident and there is a lawsuit involved, you want to make sure you have the appropriate limits to protect your assets. Health insurance. This is probably one of the biggest areas over the last decade that has caused a lot of contentious debate. From Obamacare until now, they removed the individual mandate. There still is approximately 10 million people in the United States that do not have health insurance right now. It's important, very important. Health insurance claims have really been the number one reason in the past why people filed personal bankruptcy. So understanding that, and again, the cost factors related to if you don't have the coverage and how that could impact your financial picture is extremely important. Yes, it's expensive. A lot of times employers will provide this type of benefit to you. So inquire at your job. If not, there are websites like healthcare.gov, which is the state level insurance marketplace. Look up what benefits you potentially would be eligible for. It is income based, so you will need to have your tax return from the previous year available to plug in some of the numbers from there. But please, take that seriously. Do not run around without coverage. That's usually when something will happen, and now you're going to be stuck paying these bills, and it could be quite expensive. Long-term care insurance. Statistically, at age 75, 1 out of every 2 to 3 people will require some form of long-term care for at least a year. That's the statistics. And when you start looking at the cost factors, I've personally dealt with this within my family from when my parents were in need of this type of care, and even to some other family members that were aging up. And for the cost for a home health care aid, where the majority of care is initiated for someone that is requiring assistance, the cost starts at around $8,000 to $9,000 every 2 weeks. So you can see how this can get very expensive. Having insurance in place, long-term care insurance, is an option. There are many different types of long-term care insurance. Some even have an investment component designed into an annuity or a life insurance policy that allows you to tap certain benefits within that contract for a care need should it materialize. So having long-term care insurance is probably one of the better options that someone should consider. But again, it is not inexpensive. Another way to plan for this, you could do some estate planning and sit with an attorney to set up what they call Medicare type trusts and so on. And these types of trust options protect your assets and ultimately make you available to qualify for Medicaid, meaning you've moved your assets out of your name. You're basically poor on paper, and you are able to qualify for certain benefits along the lines of Medicaid. So again, understanding these options is important. And again, when we start to really look at some of the other areas here, we look at other professionals. Liability insurance is probably one of the bigger areas that we really make sure that people have protection for if you are in a professional capacity, like you're a doctor, a lawyer, an accountant. You are faced with certain liabilities every day just by engaging in the public. So we do recommend either A, you do your business underneath a specific type of business entity, or make sure that you have appropriate liability insurance in place, what they call sometimes professional liability or errors and omission coverage. So very important to understand all of these types of insurance and how they are available to protect all of your assets should you have a situation arise. Now, talking about the estate planning aspect of this, and we really, once you get a good handle of your estate and your personal affairs, and you have everything organized, it really comes to help the people that you really care about. I personally have experienced this when I've seen it. There's been no planning in place, and in addition to people that have done all the planning, and I've seen how dramatically different the process works. Important to understand if someone is having an incapacity situation, some of the legal documents that you're going to need. When you don't have these documents in place, this is when it becomes a problem for your loved ones that are trying to provide care. So a living will, this is simply providing guidance over your final directives. Do you want heroic means to keep you alive? Do you want to go on a ventilator? Things along those lines, or you don't want those types of support measures taken to sustain your life. Again, there's a lot of factors to that, and you should discuss this with the people that you care about, your spouses, your children, your family. And when you document this information in your living will, they will receive copies of it. And God forbid something happens to you that is required, this will be on file with any hospital or doctor that is caring for you. Healthcare proxy. Healthcare proxy basically gives those loved ones or friends or family, whoever they may be, the ability to act on your behalf if you're incapacitated. So doctors and hospitals can talk to these individuals. Parents, something that you should be aware of. If your children are aging up and they're over the age of 18, they are considered adults. If something happens to them and they go into the hospital and you start asking questions, a lot of hospitals may refuse to provide you information. So having a healthcare proxy, if your child is going into the hospital for anything, for a surgery, whatever it is, having that healthcare proxy signed and on file with that facility is extremely important. The DNR order, do not resuscitate. This again is part of generally the living will. It's an important factor, again, when you determine what kind of measures you're wanting to have maintained to sustain your life. Power of attorney. Now, this is really focused on just financial matters. A power of attorney generally will allow an individual to act on your behalf for any financial transactions at the bank, with mortgage companies, insurance companies, and so on. So it's very important to have that on file with a trusted individual. Just so you know, a power of attorney terminates when someone passes away. So it is only active while someone is alive. A living trust, sometimes these are called revocable trusts and so on. This is a good option to basically help an individual have their estate avoid probate ultimately. The assets are placed in the trust. It supersedes any will that you have outside of the trust. So if you place a house into the trust, what happens is that house is technically out of your name. And when you pass away, whoever the beneficiary is of that specific trust receives it free and clear outside of the whole probate process. Now, should someone pass away, what kind of documents do they typically need? Obviously, the first one that comes to mind is someone needs a will. Again, these are a combination of documents that I would recommend typically for someone if they are going to an attorney, depending on the size of their estate. All of the incapacity items on the left-hand side here are all basic standard documents. In a lot of cases, you can pull these documents right offline and fill them out and have them notarized, and they'll be accurate. But a will typically requires an attorney, though you can do them online, and there are online attorneys that can review the will. I always believe that you should have a live attorney reviewing this for you. Testamentary trusts. These typically are created upon death where you want specific amounts of assets transferred into a trust. In most cases, we utilize this type of a trust for if you have underage children. So if you have children up until the ages, sometimes 21, 25, 30, 35, you can extend a trust for a child's entire life if you want. But the idea is that this, if you have children at those ages or younger, you can have assets transferred into the trust that is managed by a trustee that will provide any health, education, and maintenance and support that that individual needs from the assets in the trust. So it is an important item to have created as part of a trust if you, again, have underage children. Now, what happens when someone has no will? Then what happens is we have intestacy laws. Basically, intestacy means you have died without a will, and therefore now the laws of the state will dictate how the assets are distributed. I've seen situations like this play out. The first thing that the courts do is they will assign an attorney and an accountant to manage this for this particular estate. If there are any potential beneficiaries, they will typically have about 15 to 20% less in assets by the time this whole process plays out. So, not having a will is not a good solution. Go online at a minimum and get a will done. But again, speak to an attorney, have them review it, and make sure that you understand all the various nuances of a will. Again, will or no will, you can do some basic estate planning just simply by how you title a particular property or designating specific beneficiaries. For example, if you have property that is owned as joint tenants with rights of survivorship, when you pass away, that asset will automatically transfer over to the joint tenant or the joint owner of the property with you. If you have a checking account or a savings account or investment account, you can also designate transfer on death to certain individuals. So if someone passes away, a TOD designation will specifically list beneficiaries of the account. Or again, if you have an IRA account or 401k or 403b, I cannot stress enough to make sure that you update your beneficiaries. We recently had a situation where someone got a divorce and right after divorce, we wanted to get updated beneficiary designations for the account for their IRAs, and they kept delaying. They never got around to it. They were in their 50s. They didn't think it was their time. Sadly, COVID decided differently. The person passed away. They had no beneficiary designations on the account. Assets went to individuals that normally would not have been the individuals designated for those assets. So realize if you don't designate a beneficiary, you don't have a will, the courts are going to decide where those assets are distributed to and who is inheriting them. So it's very important. And again, if you do set up a trust, the trust typically will have a beneficiary designated. Just so you know, when you designate someone as a joint tenant in the title of a property with rights of survivorship, or you designate a TOD designation or an IRA beneficiary designation and so on, this supersedes a will. So if your will says all my assets go to this person, but my beneficiary designations go to a different person, the beneficiary designations on the joint property or the IRAs and so on will go to those people. The person with the will not receive any of those assets. Only the assets that are captured outside of the properties that don't have these designations. Now, there's always unexpected obstacles. We can be confronted with job loss, an unplanned pregnancy, a divorce, illness can strike. Adult children need financial help, or caring for an aging parents. There was a good saying that they used to have that in my generation, we were the sandwich generation. We had parents on one side that needed help as well as our children on the other side, and we were sort of stuck in the middle there. There's a lot of factors that can create these obstacles. And this is just, again, a short list. Lastly, if a spouse is lost, again, that's probably one of the worst situations that you can imagine. So it's important to understand what these obstacles are and get the planning done so you as an individual can plan for your future and understand what's going on in your world and have some controls over this. And again, you don't need to have all the answers, but you need to know where to go for the answers. And if you need help, again, contact those trusted professionals in your life. Now, what course are you going to chart? Again, it's all about your dreams and goals, again, and ultimately your security. And that's what this whole conversation was about tonight, is really making it, you think about yourself and what your ultimate goals are for retirement. What is that going to look like? And, what are the dreams for that for you and your partner in life? And again, having taken all the appropriate steps to create that security so you know this is going to happen. And that's probably the last takeaway that I want you to have, that all of this is possible. It's all within your reach. You just have to commit to it. And again, the simplest process is just starting to get educated and setting some basic goals. Start simply, maybe start researching individual securities, whatever it may be, but start saving. Do some research, understand, what the investment options that are available to you are. Take advantage of those retirement accounts that you have available through your workplace. All of these things are ultimately going to lead you to that successful retirement that we hope all of you will succeed at. I want to thank you. If anyone does have questions, let me just see here. No questions at the moment. So this concludes our evening. This is my contact information. If anybody has questions, please do not hesitate to reach out. I thank you so much for attending this evening, and again, make it a profitable week. Have a good one.